today we're going to dive into the process of tax planning, for retirement. So hopefully you have your pens and paper ready because this is going to be a good one. So I'm going to, give you some ideas of where to start. And then if you want to do things on your own, you can. And then I'm also going to show you that if you want me to help you out, listen, I'll help you out with some of these things as well. And we'll make sure you're all taken care of. So let's jump in and talk a little bit about the 6 key focuses for tax planning in retirement. So the first, focus is definitely going to be tax efficient investing. Okay. So you want to make sure you are invested properly, and make sure you have the right assets in the right location. That's very important. Asset location strategy, that's also very important. Of course, tax loss trading and capital gain harvesting is very important. But today we're going to focus here, around the distribution planning and Roth conversions. And then we're also going to talk a little bit about some of the tax gotchas, okay? So we're going to be here number 4 and number 6. And feel free, if you are watching today live, or even if you're watching this later, please share where you're at, what location you're watching from. I always like to know where everybody's at. But this is what we're going to be focusing on today. And so now, let's go a little bit, take one step back and go talk a little bit about where our previous case study was at. Okay, so let's pull this up here. Okay, so hopefully you can see this. So in our previous case study, we're looking at Jill and Bob F. And, Jill and Bob F came in and they had a certain financial situation between their assets and their income sources that it looked like they were a little bit overfunded for retirement. And when someone is overfunded, then the first thing that I'm going to be thinking about is taxes, right? And tax planning. So when I'm first working with a client, we're going to get them financially organized. And hopefully you remember this from before. We had their asset map all set up here. The asset map is going to have all of their assets, their income, and really their whole financial picture, on one page here. And again, this is something we'll do for you for no cost if you schedule an initial consultation. I'll be happy to do this with you. But then once we have this laid out, now we can start to look at, how is our financial situation looking from a high level, okay? And so what we found is, I ran a couple target maps, okay? And these target maps are really wonderful, and they're a quick snapshot of, how are the clients set up today, or how are you as a client set up today? And are you on track for retirement, or are you off track and we need to make some adjustments? So when I look at Bob and Jill here, I ran the first target map for retirement funding. Okay, so you see here it says retirement funding. And I ran it to age 100. So the likelihood of one of them living to 100 is about a 50-50 shot. It's not that likely, but it's going to become more and more likely over time. And honestly, if Jill or Bob are really healthy, it could definitely be happening. So you want to look this far out and make sure that you're on track overall. So when I run this target map out to 100, they're about 130% funded. So it looks like they have 30% more assets than they really need to make it to this goal if they were to spend what we expect them to spend, okay? And I also ran it again at age 90, and they're about 153% over. So these are all things that I do behind the scenes to say, where are we at, from a client perspective. But when I'm looking at these situations for Jill and Bob here, I know they're overfunded. And if you remember, most of their assets were in pre-tax accounts, which means they're going to have a required minimum distribution later down the road that's going to be larger than they need to live off of, okay? If your RMD is less than what you need for income, then this is not something you need to worry about. But if your RMD in the future is going to be more than you need, then you have to look at some tax planning, or else you could just pay the taxes. But nobody wants to do that, right? Everybody wants to save and plan and have a good situation around taxes. So I thought today we would take a little bit of a step back because I'm going to go over some things here that I pull up and create for clients, and I create really nice reports that look very clean. They do not have to go through their tax return, okay? That's not what I want anybody to do. But I want you to understand where some of these things come from, and maybe you've never taken the time to just look at your 1040. And your 1040 is your federal tax form if you're not even familiar with what this is. But your 1040 is something you have to generally file every single year. If your only income is Social Security, then you don't have to file this, by the way. But everybody else who has some sort of income is going to have to file a 1040. And there's also other forms you need to include, but we're going to talk about this for today. So when we talk about the key figures you need to know to do some of the planning we're going to talk about here, this is where I want you to go to get these numbers if you want to do this on your own, okay? Because like I said, I want you to learn to do some of this on your own. Do I want you to have to learn everything about taxes and tax planning. No, I would like for you to reach out to a tax-focused advisor or reach out to me. We have some capacity. I have a little bit of time off these next few months. I would like to really help out some people if you're interested. But again, maybe you want to do this on your own, and that's fine. So some of the things you need to know here are where you need to find some of your key numbers, okay? So the key numbers you need to know to start with is your total income, which is here on line 9, okay? So you need to know that, so let's get that number down. And then you need to know your adjusted gross income, which is line 11 here. And for most people, line 9 and line 11 are going to be the same unless you have some sort of adjustments to income here from Schedule 1. But most people, 9 and 11 will be the same. And then you need to go here to line 15 and get your taxable income, okay? So we need to know what your taxable income is because that's going to tell us what marginal tax bracket you are in. And then the last thing we'll need to know to start here is the total tax you paid, which is line 24, okay? So this is your 1040. These are the numbers you need to get. But what I do for my clients is I just create this really nice report, okay? Makes things really easy to see, and it helps us just pull in, all of the key figures as you see at the top there that we need to know. And you're not sitting there searching through a tax form, okay? And if you want to, I'll do it for a couple $100 and we'll set you up if you want a tax report like this so that you can do some of this on your own. But just feel free to reach out. But the place I start here is I just pull up this tax report because I don't want to sit there and pull everything out of a tax return. So going back to what we were speaking about here, folks, we have our total income right at the top here, which would be our line 9. And then we have our adjusted gross income, which is our AGI, which is the same here. And then line 15, we have our taxable income, which is here. Okay, so they got the standard deduction of $27,700. And then right below this, you're going to see what line 24 is, and that's the total tax that they paid, right? So some things that your tax preparer may do for you is help you understand what marginal tax bracket you're in and what your average tax rate or your effective tax rate. And they may do that. It's probably on your form somewhere. A lot of tax preparers do that. But again, we provide this right here on the tax report. And right here, we're going to see that they're currently in the 22% marginal tax bracket, right? And if you remember, we have what's called a progressive tax system here in the US. We have you can either call it the 0% tax bracket or the standard deduction, which is here. And then we're going to have our next level of tax brackets here, which we call the 10% bracket. So what we're doing here for Jill and Bob is we're doing tax planning for 2023 in this year. Okay, we want to see if there's any opportunities for them to save taxes in this year. And, tax planning, it's a great end of year activity, but it can also be done throughout the year because there are opportunities depending on what's going on in the world. And for example, the market's still down, over the course of 1 year. It's up for the quarter, by the way, quite a bit, but it's still down year over year. So you could still look at doing some of this now. And maybe you do want to do a Roth conversion in 2023. And, now there could be a worse time than now while the market's down. So you can see here their tax brackets. For the 10%, it's 0 to 22,000, and then for the 12%, it's 22,000 to 89,450, and then for the 22% bracket, it's 89,450 to 190,750 dollars. So what we're seeing here is Jill and Bob, their taxable income is about $108,260. So that puts them just a little bit over the 22% bracket. So I start to see some very interesting things here that we can dive into as we're going to go into that. But before we do, I want to talk about one more thing. And then the second thing I want to share with you is we have what's called a parallel tax bracket system here. So we have our marginal tax brackets, and then we also have our capital gains tax brackets. Okay, so capital gains and qualified income, dividend income, is taxed as follow. For them, if your income is below $89,250, then you pay no tax on capital gains or dividend income. Okay, and that income is included in this calculation, by the way. But if they're above that, then they're at 15%. Okay, so most people are going to be in the 15% range for the most part. But if you're somebody who is retiring, or maybe you're transitioning into retirement and your income's a little bit lower than it was prior, this could be something really interesting for you. Okay, so we'll come back to this. But one thing to notice is the capital gains bracket is $89,250. The 22% bracket starts at $89,450. So it's like a $200 difference. Don't know why they do that, but it just is, what it is. So with that, if you remember from our 10 key items that we want to look at from our tax report. We want to review the adjusted gross income, which we did, our taxable income, our marginal tax rate, and our total taxes paid. We've done all of that. And then we want to look at how much room is left in the current ordinary income bracket and what the next closest bracket is. Same for capital gains. So we've done that too. So we can see here, we have a lot of room left in the 22% bracket, a lot of room here. So there's a lot here that we can do if we want to optimize for the 22% bracket. If we want to optimize for the 12% bracket, then there's a little bit less we can do, but there's still some things we can definitely do. And one thing that we want to think about is, hey, you know what? We're only a little bit above this 12% bracket. Okay, so we're just a little bit above that. So we are about, $18,000 here above the 12% bracket. So if we have some options here, we could possibly lower Jill and Bob's tax bracket for the year to their marginal tax bracket down to 12%. Okay, and I talked about this a little bit at the end last week, but I want to dive in just a little bit. So if we can reduce their income, which we did find out that Jill has a 401k, we can get Jill and Bob's marginal bracket down from 22%, which they're at now, down to 12%, because you can put up to $30,000 if you're 50 or over in a 401k. And if you have two spouses that are working, you can put $60,000, so that's $30,000 each. That's $22,500 standard contribution. And then you got the catch-up contribution, which starts at age 50. That can be another $7,500 in 2023. So all this could be some really, really interesting things. So if we contributed, remember the C words, we have two C words, contribution and conversion. If we make a contribution and Jill maxes out her 401k, because remember, Bob is retired. So Bob's already on Social Security. He's retired. Not much we can do with him. But since Jill has a 401k available, and if we put the maximum contribution of $30,000 and we take $30,000 off of the $108,260, we will now be down at $78,260, which would put us solidly in the 12% tax bracket. Okay, so if we wanted to do that, that's one thing that we can do. So to do that, we would need to put $18,810 at a minimum to her 401k, and that would get us to the top here of the $89,450. So these are all ideas, right? So when I'm starting to look at this, I just start to look at ideas that I can bring to the client and say, hey, what makes the most sense for you? Do you want to save taxes today, or are you more concerned about taxes going up later? And, these are all things that, again, we're going to do our best guess because we don't always know. But this is where, we're going to start. And the idea of putting the full $30,000 in is great into the pre-tax 401k. But if we look at our average rate, which is 10.6%, our effective rate here on tax is 10.6%. If we put $30,000 in Jill's 401k, that's going to save us about $3,000 in taxes this year. Okay, so that could be a good idea. But you always want to be looking down the road. And here's something that I keep seeing over and over. Okay, I'm sure most all of you have a tax professional of some sort. Maybe you're your own tax professional. But even if you work with very good CPAs and tax professionals, they're very focused on saving you taxes this year and last year. Okay. They're not trained in looking forward on tax planning and what things could be looking like for you in the future. That's just not part of the CPA training program. Remember, they're called certified public accountants, right? They're more of an accounting type of training. Working with an advisor like myself, a certified financial planner, ideally one that's focused on tax planning for you, we have our crystal ball, okay? We have a crystal ball, and we can see in the future that if you're somebody who's not going to spend all of your money, you may have a required minimum distribution in the future that's more than you need, which could bump you tax brackets. So we're going to get into some of this as well very shortly here for Bob and Jill. But this is part of that conversation. So maybe Bob and Jill are like, you know what? I understand that. So I want to optimize a little bit. So instead of putting the full $30,000 in for Bob and Jill and getting down to the $78,000 number. Is that what we said? It would be, yeah, 78,260. I want to put in just enough to get to the 12% bracket, okay? So if we put in just enough to get to the 12% bracket, then what we can do is instead of contributing the full $30,000 to Jill's pre-tax 401k, we can do something else. And that would be possibly contributing to 2 Roth IRAs. And if you remember, Bob can still convert to a Roth IRA even though he's not working because Jill has enough earned income to cover the contribution for both of them, okay? So, these are things that are really it's going to come down to like what you really want to do and what you want to have. But if we put in just enough to get into the 12% bracket, well, then we can fill up 2 Roth IRAs for Jill and Bob this year, okay? So these are all things that, may or they may or may not want to do, but it's just going to depend on their situation. So Michelle asked, so is this correct? You cannot do a Roth conversion since I'm at my current job, state job, unless I quit or retired. Is this correct? No, Michelle, that's not correct. You can do a Roth conversion anytime. So Roth conversion can be a very powerful thing to consider. Let's say if you're maybe in a part-time job because you're transitioning to retirement and your income has dropped significantly, you can definitely do that. So that's not true. You can definitely do Roth conversion at any time, but it may not be beneficial to do that necessarily. She had one more question. She wants to slowly move some 401k with a Roth conversion each year until she retires in 4 years, but someone told me I cannot since I'm still working unless I quit or when I retire. So Michelle, the thing that could come up here is you have to do what your plan allows. So your 401k plan may not allow this, but generally you can do this. There's no tax block that you cannot, you wouldn't be able to do this. You can definitely do that. And there are some plans that allow in-plan conversions where if you have a traditional 401k and a Roth 401k, you can convert inside of your plan. So that may be something you want to look at as well and see if your plan has a in-plan conversion option if you have a Roth 401k. But the only thing I can think of here is your personal 401k plan does not allow that. So you want to get your summary plan document and review that, or just speak to HR and just see if that's actually true. Because sometimes you cannot do that. So that could be the case, but many times you can. But really good question. Let's dive back in here a little bit. And so far we're looking at Bob and Jill's, current tax planning situation for federal. And so if we put the full amount of $30,000 into Jill's 401k, then it looks like we would save about $3,178 this year, okay, if we wanted to do that. If we just put only the amount to get them to the 12% tax bracket, we would save about $1,678.50. So again, this is going to be, you're going to pay taxes on this money at some point. This is why you need to look at the whole picture and see, does it make sense to pay taxes now or pay taxes later? Right? So all good stuff there. One thing to look at is, we're already at the 85% range for Bob's Social Security. We're paying tax on 85% of that, so there's really nothing to worry about there. But what I like about this tax report that we can prepare is that we can get some state tax hints as well. So in this case, we have some potential state tax that we can save for Bob and Jill. And Missouri, their tax rate right now is 5.3%. So anything we save on Missouri tax is 5.3% in the bank. So we could potentially, if let's say Bob and Jill had some grandchildren or maybe some children, they wanted to fund 2 529 plans, which are college savings plans, they can put up to $8,000 each in this plan and get a state tax deduction. So if they decided to do that, then they would save $848 there. So if we put the full $30,000 in the pre-tax 401k, that's going to also lower our state tax. And let's say we put the money as well, some other cash that they might have had saved, into 2 different 529s, and we add all that up. That's going to be about $5,640.50 in taxes that we can save this year, right? So $5,000, $5,600 in taxes we're saving this year is nothing to shake a stick at. So again, these are all things, folks, that, it really depends on what your goals are. So if your goals are to save taxes now, then we may approach it with one philosophy. If your want is to save taxes in the future or maximize for the future, then we're going to approach it with a different philosophy. Okay. So all really good stuff there. And if you have any questions, please go ahead and drop those down in the chat. But we are now going to move on to a little bit of our retirement income planning discussion. So Bob and Jill only need $78,000 per year. $70,000 per year. It's a very, very low income need. When I'm working through a plan for a client, first of all, we got them organized. We had their asset map laid out. We ran a couple target maps and I saw, okay, you're probably overfunded for your need. Well, now we need to start to think about, when it comes time for retirement, how much can you actually spend safely? Okay. So we have this beautiful tool that we can help clients figure out what the amount they can spend safely is. And this tool follows what's called a guardrails philosophy. Okay. So what that means is we're going to start with a certain number that's safe to spend. And if their accounts grow, then we can let them know when they can spend more. Alternatively, if their accounts drop, then we can help them understand that they may need to bring down the income a little bit. But the reason I like this is because so many people sit there and get frustrated and start to budget every month. They're filling out spreadsheets. They're just using a Monte Carlo that says, hey, you're somewhere between 75 and 80% on track, or maybe you're 90% on track, which a Monte Carlo is great. It's better than nothing. But I like to get a lot more specific. And now there are tools available that are much more advanced that are going to allow us to give a specific number that Bob and Jill can spend. And if they don't need to spend this much, great. But as long as they stay under this number, then we know they're going to stay on track long term. So in this case, Bob and Jill can spend about $9,060 a month today. I should say when they retire. Okay, so their projected retirement date for 2026, their accounts are projected to grow to 1.1 million. And then at that time, including all the other incomes that they have, they're projected to have a safe spending number of $9,060. Okay. And so what I mean by the guardrails philosophy is that if their accounts increase, so they're expected to be at $1,105,000 by the time they retire. Well, if their accounts go up 5% and go to $1,161,000 and they increase by 5%, well, then we can increase their income at that point by $450, which happens to be 5%. And that would bring their income level to $9,510. So as an advisor, this is what I'm looking at every single month in the background for all of our clients that are on retirement income, that if they want to spend more, that they can. We know Bob and Jill do not want to spend anywhere near this much, but that's okay. And, everyone's a little bit different. But let's say they did want to spend the $9,060. Well, then we have to keep an eye out and make sure that if their accounts get off track, that we reduce that spending if we need to. So in this case, if their accounts drop by 25%, so that would be a $274,000 drop like you're seeing here, down to $831,000, then they would have to decrease their spending by about $450 down to $8,610. So that's a very large drop to have to make any sort of adjustment. So this would be considered a very safe plan, okay, for them. So it's very unlikely they're going to have to make too many adjustments over time, downward, I should say. They may get to make plenty of adjustments upward. But let's say they didn't feel like $9,060 was enough and they wanted to spend more. Well, if we go up here and we raise this income to $9,360, what that means is there's just a bigger chance that they're going to have to make an adjustment downward at some point. But in reality, folks, you really want to enjoy your best years. And if you can spend a little bit more in the first 5 to 10 years, you're probably going to get a lot more benefit out of that than underspending those first 5 or 10 years and now wanting to spend more maybe in your 70s or later when you just can't do as many things. And I personally have seen too many situations change very quickly where maybe someone's back is not the same as it used to be, or their knees, or their overall health is not the same as it used to be. And then we can talk about, COVID stripping away 2 years of our lives where people that retired and just, they could do things, but they couldn't do the things they wanted to have planned. So I've become a very big advocate of really maximizing the early years. And using a tool like this, we can make sure that that you're staying on track long term. But again, everybody's a little bit different. So what I would recommend in this case is about that $9,060 for them to spend. So what's that going to look like for these folks here? So let's take a little bit look at their cash flows. So currently, Jill's still working, okay? So if you go down from top to bottom here, if they wanted to spend this much, they could start spending a little bit more today if they wanted to. But currently we have portfolio withdrawals at 0, Jill's SSI at 0, which are Social Security income. Bob's making about $1,800 a month. Jill's making about $100,000 a year, which is $8,333 per month. And then we have some rental income for $917 and $550 right there. So this is going to continue, through here the next 4 or 5 years or so, until we get to 2026, the end of it there, which is when Jill's planned retirement date is. And then we're going to move from, employment income to Jill taking her Social Security, and then also potentially an additional portfolio withdrawal. This is the amount they can take. But in reality, they just don't need this much. So, it's just something to think about, because we know they're overfunded. But again, they told me, hey, Jason, we don't need to spend that much. We're going to be fine. So I personally, I'm not going to tell you to spend more than you need to spend. But then what we want to do here is, okay, we can spend a lot more than what seems like they can based on their financial situation. Well, now we need to talk a little bit about taxes. In retirement, we have control over certain things and we don't have control over other things. We have control of how much we take out of our investment accounts that are Roth accounts, that are taxable brokerage accounts, and that are just cash accounts. When it comes to our pre-tax retirement accounts, which is what the majority of people have, like pre-tax IRAs and pre-tax 401ks, we don't have as much control. At age 73 or 75, or maybe you're already on doing this at 72, we have to take what's called a required minimum distribution from our account. And those can get quite large over time. So when I look at a client that doesn't quite need as much as they can spend, I start to look forward and say, hey, what are these RMDs going to look like in the future? So let's explore here a little bit before we talk about this current situation. And what we're going to start with here is, what is Bob and Jill's situation going to look like if they don't do any sort of planning? They just spend their $70,000, which means they're probably not going to touch very much at all of their pre-tax retirement account, and they just kind of let life happen. Okay. So what will happen is that we are going to be going to different places of income over time. So currently, this is what their current income situation looks like. So if we look at 2023, this green income here, the big block, is the taxable ordinary income. This blue block here is the non-taxable Social Security income. So we got about $3,240. And then this dark green block here is a taxable Social Security income. And then this kind of magenta block here is our rental income. So it's other taxable income. So each year we can analyze and look at about where you're going to be. And if we look here on the bottom left here, it's a little bit light gray. So hopefully on a big screen you can see this. But if you look here down at the bottom, we have the 0% tax rate. So this would be the standard deduction here. We have the 10% tax bracket. We have the 12% tax bracket. And we have the 22% tax bracket. So you can see here for these folks, we can generate here about $120,000 and still stay in that 12% tax bracket, based on their current situation. But once we go above that number, now we start to pay at the 22, and we really want to avoid that if we can. But if we go forward here, let's say after the year Jill retires, well, we're going to be in a pretty low tax bracket right away if we don't need any money. And so for Bob and Jill, if they were to take the full distribution to get to the the income we could potentially generate for the year, they would still be in what's the 12% bracket now. But remember, the 12% brackets are going to reset in 2025, and it's going to go to 15 unless something changes and stays the same. So they're going to still be in the 15% bracket. So everything overall looks pretty good the first couple of years. We're still in the 15% bracket the following year and so forth. But then look what happens in 2039 when we start to get to RMDs, because Jill is only 58 and she has the big retirement account. So initially things don't look too bad, right? We're still in that 15% bracket with the RMD. but it's still, a $70,000 RMD, okay? And remember, they don't need this money, right? And as we go further and further in retirement, especially, later down the road here, these RMDs get quite, so if you look in the future here, this RMD is $130,000. They're going to be up here in the 25% tax bracket with maybe $250,000 in the future, which is just some income that they just don't need. So, and one thing we need to remember too is the tax gotcha, which is the widow penalty. And so right now I have this set on joint filer tax brackets, but if Bob or Jill were to pass early, this all goes to single filer tax brackets. So what would this look like if they had, $250,000 of income? Probably be at least in the top of the 25% bracket, maybe even the 28% bracket at that point. So as we go forward over time, we start to see that, these numbers just keep going up and keep going up. And it's just going to be a lot of taxes that they don't necessarily need to pay in the future. So let's compare this with what we call a bracket management strategy. So for Bob and Jill, if we started a bracket management strategy and we started that when they retired, so we'd start that in the first year here when Jill's income drops, we could do a Roth conversion of about $104,000 in that year and do these each year going forward from 2026 through 2033 and maximizing this bracket. If you go forward here back to 2038 and beyond, we have no RMD income ever, right? Because we convert this account. No RMDs ever again after this. So their only income is going to be whatever they have from Social Security, whatever they have from their rentals, and that's basically it. So if we look in the future, way down the road here, instead of being at $250,000 plus of income and in the 25% bracket, they're going to be below the 10% bracket projected, even with $160,710 of income. So they're never going to go above this 10% bracket in the future. So this is where it gets really interesting to look at some tax planning. And when you put the whole, picture together here, if we don't do any planning, we know they're going to be in the 25% bracket forever, and that's their marginal, if you remember that. So their marginal bracket will be 25. Their effective or their average tax bracket is going to be about 14.1 over their whole retirement period. If we do some tax planning and look early at some Roth conversions, we can bring that down to 8.7%. And so that's an effective rate drop of 5.4%. And by paying the taxes early, which I know a lot of people don't want to do, by the way, but if you pay the taxes early and then you're not paying all those higher marginal rates later, in this case, we can save them almost $500,000 in taxes over time. So for those of you that really want to do things on their own and not pay a financial advisor, it might be costing you a lot more than you think to do that. So, these are all things that could be beneficial for you. And I will tell you this, folks, the bigger your pre-tax account is, the more benefit this is going to be. I've seen these numbers go up quite a bit, but it also depends on how much you need to spend too. So all this needs to be analyzed for you as an individual. But again, these are all things that, we can look at for you if you like. But if you look at what the taxes Bob and Jill are going to pay are, then, early, they're going to have to pay some taxes, right? So they're currently paying about, $26,000 a year in taxes total. So for the first, 6-7 years of retirement, we're going to double that to about $54,000, $49,000, $51,000, $53,000, and then we're going to end at about $59,000. But then from there, we're only going to have so the blue is the bracket management with the Roth conversions. The yellow is what their life would be like if they never did any tax planning. And so what happens is we go to basically paying next to nothing in taxes after 2035 for Bob and Jill because their taxes are going to be so low. We don't start paying anything till later until our accounts start to grow and we take distributions to pay for other things. The yellow is if we don't do any tax planning and we have to end up paying all these taxes later. So regardless, you're going to pay these taxes at some point. And the thing is do we know exactly, when you're going to pass away? Do we know exactly how things are going to turn out? Do we know exactly what the future tax brackets are going to be? No, we don't. But if we have a plan like this, and we can then get as much money out of the government's decision-making process as possible, then that you think you're going to be better overall at the end. The second big consideration is to think about really how much taxes you want your children to pay or your beneficiaries if you left money behind. Because the other thing we didn't talk about yet is we had the I think it was the Secure Act that changed the RMD, the distribution on non-spousal beneficiaries without an exception. Like, so if, for example, if your kids inherit your IRAs or 401ks, those accounts have to be completely depleted within 10 years. I'm starting to get some of these accounts now since this rule change, so I'm starting to deal with this now. So imagine if you pass on, a multi-million-dollar IRA at the end of your life, and then your kids have to pay taxes on that over 10 years. That account, maybe 30 to 50% of it will be gone to taxes. So by doing some tax planning today and getting as much money to Roth as possible, yes, they will have to take the money out of the Roth account, but it'll all be tax-free over time. So not only are you benefiting yourself today, like in Bob and Jill's situation, saving, I think we had $500,000, $500,000 or $486,151 in taxes. We're also going to increase the legacy by $281,274 as an estimate. So they're going to, in this case, be passing on about $4.7 million, $4.669 million. And this will pretty much all be tax-free, where if we did it here, it would be mostly pre-tax, and this would be taxable income for their heirs. So there's all these different working pieces that we need to intertwine and work together when we're creating a tax plan. So we take these things here that we talked about today, and then we're going to layer on our tax efficient investing, and then we're going to layer on our asset location strategy, because maybe money that we don't need, like our Roth money, that could be invested more aggressively. And money we need sooner, like some of our pre-tax IRA money, that needs to be aggressive more conservatively. So if you add those variables in there, then all these numbers actually get better, because we're going to have more aggressive investments in our Roth accounts. And I'm just using a standard, 60-40 across all accounts here. So again, hopefully this was valuable to you. This is the next level of tax planning that you need to go into once you understand, all the basics and you get through those 6 key focuses. So if anybody wants a tax report, feel free to email me. If you want to go to my website here, you can find our calendar page at keepitsimplefinancial.com/talk. And you can schedule a complimentary consultation. And when you go there, you're going to set an appointment. You're going to fill out some information. And then you're going to fill out the information I need to create that asset map for you, that original, really beautiful financial picture. And I'll give that to you, after our conversation. But if you want a tax report, that's a little bit more work. And so I'll do that for you, but please reach out to me and I'm happy to help you out with that. I hope I provided some value today that you can actually take home and put into practice, especially around where to find all that information on your tax forms. So I would start there, figure out where you're currently at, where you might be in the future, and then start working your way backwards with your tax plan. And if you need help, feel free to reach out, okay? Wish you folks a wonderful day. Have a wonderful weekend. We'll talk to you next time, all right? Bye now.